Welcome everybody. Thanks for taking time out of your busy schedule. Happy New Year. Happy 2022. My name is Tom Hutchens. I'm Executive Vice President of Production at Angel Oak Mortgage Solutions. And our special guest today is Manish Valecha. Welcome, Manish. Manish is the Head of Client Solutions. Manish, if you don't mind, maybe just give everybody kind of a little overview of what that means.
Yeah, sure, Tom. Thanks for having me. So I work on the capital side at Angel Oak, and really my role is working with our investor base that invests in our non-QM collateral and our non-QM production. And the non-QM market has grown significantly, and it's kept me quite busy in terms of developing relationships with investors that come into our products and invest in our securitizations. So that's really my role.
Awesome. Maybe even a quick update. What was the first Angel Oak, or when was the first Angel Oak non-QM securitization?
Yeah, so it was actually done in 2015. So the years have flown by, and fast forward to today, we've done about 28 securitizations now, over 10 billion in origination and securitizations. That's over 26,000 loans. So it's been quite a growth trajectory that we've been on, and it's been great to sort of see that over this time.
Yep, same thing. I came here in 2014 when we just had a couple people and just trying to get this whole non-QM thing going. It was pretty exciting last year in 2021 because you mentioned you guys have securitized over 10 billion, and we hit the over $10 billion mark in origination. So just so everyone kind of understands, Mortgage Solutions, we're on the origination side. We have a wholesale and correspondent channels, and then Manish and Angel Oak Capital, they take our loans and they create an exit strategy, which in most cases is the securitization market. So speaking of that, let's maybe what did 2021 look like, Manish?
Yeah. I mean, look, it was a stellar year. I think overall for the market, 27 billion in securitization volume. So what does that really mean? What does that number mean? So it means significant year-over-year growth. There was about 18 billion or so done in 2020, which was obviously impacted by COVID. But what we've really seen and gets us really excited at Angel Oak is behind those numbers are actually investors, and we're talking about pensions, global investors, insurance companies, money managers that manage capital on behalf of different investors, around the world, institutional and retail. And we saw that investor base grow significantly and really sort of continue to validate the asset class post the COVID situation in 2020. So I think that was what was sort of very significant for us from a 2021 perspective, was just the continued growth on the heels of what was happening kind of globally around the world with COVID. And really, if you think about non-QM, non-agency, it's really a product, an area that investors look to provide yield, to provide income, to provide exposure to the U.S. housing market outside of what the agencies are doing. And just to see that growth take place in 2021 on the back of 2020 was a pretty successful year from that perspective.
Well, what's pretty awesome about it, because you're kind of like with the investors on the back end through securitizations, and we're seeing the same thing on the origination side. We saw lots of growth in number of originators doing business with us. We set a record for the most volume. We were just right around 4 billion in non-QM originations last year. So it was a great year for us to grow together. And, that kind of just, what do you think about 2022? I'll just, we're looking at probably 7+ billion in non-QM originations just from us. What are you seeing kind of market-wise, securitization and things like that?
Yeah, I mean, first and foremost, I think the product has been through a stress test. It's been validated through what was, arguably a pretty traumatic event from a capital markets investment perspective. And you saw the credit performance, you saw delinquencies continue to trickle down, and people just have sort of gravitated to the asset class from that perspective. So we sort of see a continued growth in 2022. I mean, if you think about industry forecasts, people are forecasting a 40 billion year from an issuance perspective, which would be the largest year since inception of the asset class. And so we continue to see that growth. We plan on in our partnership with the mortgage side here, we plan on being an even more frequent issuer of securitizations than we were last year. We did 8 deals last year. I think you're going to see us exceed that number this year. So I think it's shaping up to be a pretty active growth story this year. And I think the reality of it, Tom, is we're still in a low yield, low income environment, and the investor base just continues to gravitate to the asset class.
And I mean, you have to even talk about it, since you said the first securitization was 2015, but a lot of that has to do with what? The quality of the loans themselves. Isn't that a pretty huge factor to keep investors and more investors getting more and more interested every year?
Yeah, I mean, I think, from an investor perspective, what they really want to look at, Tom, is they really want to think about relative value of non-QM as an asset class versus other asset classes. And they factor in a few different things there. One, they factor in, what sort of delinquency, default, credit expectation they should have for the asset class. And, one of the questions that we historically always used to get, and this, Tom, is just, hey, what sort of performance can we expect through a global financial crisis to 2008 to really sort of a stress test, and we have that answer coming out of the COVID time period. And so when investors sort of calibrate and think about the different relative value, different asset classes that they could invest in, whether it's corporate credit, non-QM, or different asset-backed securities across different sectors, non-QM stands out, just given the performance we've had.
Well, it kind of reminds me when we started this, and even the term non-QM was new to the market, and some people were saying, "Oh, here we go. This is just subprime 2.0." And what we said then and what we continue to say today is that that's not it at all, because we really for this model to work, what's different between kind of the post financial crisis and pre is that we're all under one roof. So the performance of these assets, the performance of these loans is critical to our origination. Whereas pre-financial crisis, there weren't a lot of relationships between originators and securitizers, but here at Angel Oak, that's completely different. So it matters, and it's going to always matter. And then when I started thinking about 2022, we start thinking about agency rates, and we're seeing the Fed continue to raise rates. I don't think there's any doubt there's more rate increases coming, and on the agency side, that brings margin compression, so it becomes challenging for lenders. There's less loans out there, and then you have to compete even more to get those loans. So rate increases, margin compression are real, which is probably why a lot of people are on this call with us today, and I think that's going to continue throughout 22 and beyond. A lot of people have asked me, and I'd love to hear your perspective, Manish, but the market, we've always talked about being a 200 to 300 billion annual securitization level. And, you're talking about this year, maybe 40. I actually think it's going to be maybe a little higher than that, just because of what's happening on the agency side. But what do you see when people ask you about that, as far as size of this whole market?
Yeah, I mean, I think generally, and the investors have bought into this, by the way, from an investor perspective, whether you're a pension or your money manager, you don't want to be investing in an orphaned asset, right? You want to be investing in an asset that you can grow with, that you can continue to allocate capital to, as your investment program sort of evolves. So I think investors sort of, gravitated to this idea that, if the non-QM market is 40 billion, that it needs to get to some sort of normalized level, which was historically where the non-agency market was, pre global financial crisis. Maybe if you look at, the 2000, 2002 time period, which we've talked about, as being a 250 to 300 billion dollar market. And they've also bought into this idea that right now the agencies are continuing to evolve and continuing to step back from areas of the mortgage market. And so this creates a larger opportunity set for the investor base. So we've talked about this going back to last year on the agency investor side, the investor loans that flew through to the non-agency market and became a $20 billion market, in terms of issuance when the agency sort of imposed that cap on the investor loans. And so I think it's continuing to be an evolving landscape, but I think people sort of have anchored to the idea that non-QM is here where it's at 40 billion, and it's going to get to 250 billion over time, and that's really going to be driven by the policy changes, which I know you guys are watching very closely. With the recent changes.
The FHA started 22 out with major price hits for second homes and some of the larger jumbo agency loans. So no doubt the policy changes. I mean, what do you think? Just what's your perspective? I have mine on even last year with the non-owner restrictions on volume and things like that. What do you any further thoughts around that?
Yeah, I mean, what we saw was just so it wasn't just a few sort of investors that had said, hey, this is an interesting product. We saw a pretty deep buyer base develop very quickly for that agency investor product. And what I mean by buyer base is I sort of think about it in a couple different ways. One is just the size of the market, how much issuance was done, and how much sort of product was out there for institutional investors to invest in. And so you saw a $20 billion market sort of appear very, very quickly, which gives you an indication there's a lot of demand. And then a couple of different dimensions there too. You saw a deep buyer base of different institutions globally that were coming in, whether it was a sovereign wealth fund or a global pension or a money manager. And then you saw a lot of market participants come in as well. Folks like us who were looking to securitize the collateral. So
right.
on all these sort of different dimensions, we saw a lot of growth, which tells you that the market is capable of absorbing the product.
Which I almost feel like 2021 was a bit of a test to see, okay, if we make these really significant restrictions in the mortgage on the agency side, is that going to kill housing and or kill the mortgage market? Because that restriction, that 7% cap, I was talking to lots of our customers, that's a really hard thing for originators to implement. So they took it away, but the market didn't implode, right? As you said, investors from all around the globe just started coming in almost immediately. And I feel like that was a test. Maybe that 7% cap wasn't the right way. So they started 2022, brought on some, really some pricing adjustments, which that's something that each lender will kind of level set based on that new pricing. But it kind of just, I feel like do you think there's more to come? I mean, I feel like there's probably going to be more coming.
Yeah, absolutely. And I think from a regulatory policymaker perspective, right? I mean, you want to sort of test things out before you sort of rip the Band-Aid off, right? And the idea is, hey, the housing market is the one, it's one of the few places where there's a lot of strength in the economy coming out post-COVID. And, you've seen 20% home price appreciation year over year and so forth. So, the last thing you want a policymaker or regulator is sort of, mess that up. And, right. And sort of doing a test and then having the market respond the way it did, I think should give them confidence moving forward, as they just indicated earlier this year.
Yep, I agree, and I think it's, to me, it also lends to the audience here is, lenders need to form relationships with with non-agency outlets. And you know, that's really why we've been in the space for as long as we have been, because we've always believed there always is a need for outside of the agency lending, whatever that looks like. But now it looks like the non-agency piece is probably gonna, that market, it's gonna grow organically. But when you tack on industry or policy, government policies changes, that's going to even really emphasize that. So anybody who's not getting ready for that needs to, because I think there's more coming down the pike.
Yeah, no, I think that's absolutely right. And you know, I think you know, this is probably the beginning of these gradual changes that you'll see taking place as the agencies continue to step back from the market. So 100% agree with you on that.
Yeah, the mandates of the agencies were never to give that person buying the beach house the best rate,
Right.
government guaranteed kind of loan. That wasn't how it all started. So
Right.
I think they're getting back to, or they're realizing that, and now making changes to affect that. Let's talk about just, you know, there's probably quite a few originators on this. Maybe let's talk about how the relationship, you know, how we're kind of affiliated companies. How does that impact an originator? You know, like, I don't want to say why do they care, but why do they care?
Yeah, I mean, I think, you know, the fact that we are 100% aligned, that it says Angel Oak on both of our business cards, I think means a heck of a lot to the institutional investor base that invests in non-agency loans. Mm-hmm. And, you know, the pensions around the world, the insurance companies and so forth, they take comfort in the fact that, you know, we are one integrated platform, that there's a feedback loop between them and the originator. And you know, and then from your perspective, obviously, you know, that provides certainty of execution, which is absolutely critical, you know, and certainly you can speak to this from your seat to what you need to do. So I think having that feedback loop between the end investor and what you're doing literally on the front lines in manufacturing the product is absolutely critical to success. And look, I mean, at the end of the day, you know, we've done over, you know, 10 billion in securitizations, over 26,000 loans. So, you know, we had over 53 buyers last year, Tom, of our securitizations, which is you know, just to give people some, that's a pretty sizable number of investors that have bought into our program just last year. And so, you know, that provides a lot of execution certainty, which is what you need when you're on the front lines. And I'm sure you can expand on that.
Well, the surety of execution, what we hear a lot from our customers is that Angel Oak, when we give an approval on a loan, we know we're closing, we meet those conditions, we're closing that loan. We don't need investor approval or product approval. We've worked extensively over the years, but we do on a regular basis of fine-tuning the guidelines. When we started this, I think 30+% of our originations had an exception. Well, we've seen that number just come down a lot, and the reason is that we found ourselves, if we were making the same kinds of exceptions and we liked the loans and investors liked the loans, we would change the guidelines, and then it's no longer an exception. But even so, we've always had that authority to make exceptions on good loans. So surety of execution, when even it starts, you talked about on the ground floor in the trenches, when one of our account executives tells a loan officer we can close a loan, we can close that loan. And I've heard lots of stories of loan terms and loans themselves getting changed throughout the process based on investor approval or denial or counteroffer and things like that. And that's really not how it happens at Angel Oak. So I think it's a model that's built to last. It was certainly built to get this thing started, because in 2013, 14, it would have been hard to do this standalone for either of us. But now that we've grown this together, the benefits that helped us grow it are going to also help us continue to scale this business. And I mean, I think about pricing. You mentioned 54 different investors last year. That's going to when there's a higher demand, that's gonna shrink that pricing, and so rates are impacted by that. You know, I don't know that people really understand that, but demand is going to keep drive that rate lower ultimately. Guidelines kind of already talked about, but even new products. I mean, last year I think we had over 25 real product enhancements just in 1 year. So you know, that's what we always talk about with our partners over in Angel Oak Capital is, okay, what are the investors saying, and then that connection to us, we kind of say Main Street to Wall Street. You know, what's the feedback from the originators? What are the loans that people are missing that are good loans that we want to originate? And that's kind of somebody called it the power of Angel Oak, and I think that's pretty accurate.
Yeah, no, I think that's absolutely right, Tom. And you know, having been here a long time, the conversations have gone from being an educational conversation with the investors about this product to more about, hey, would you be able to originate this, and what sort of products are you working on, and what sort of tweaks can you make, and so that feedback loop has been very critical. And you're absolutely right too on the rate side. You know, where we execute the securitizations, there's a direct link to the rates that can be offered, you know, from your side.
Yep. And the other thing I think which kind of encapsulates the power of Angel Oak is that this is going to be a big year. 23 is probably going to be an even bigger year. But we talk about on our side that there's more investor demand than there are originations right now. So we have been from day one always talking about how to scale this business, how to make it easier for originators to originate these loans. You know, we've got a lot of big plans on the technology side to, you know, this isn't DU where you've got a machine kind of giving answers. It's been a pretty manual process, but we talk a lot about what are the efficiencies we can use in technology to make these loans even more streamlined. You know, one example is our bank statement calculator. We calculate that very quickly up front in the process, and we do that because we learned that over the years. That's the best way to do it. So, you know, I think the partnership and us knowing that Manish, you and your team, you're out there getting feedback from investors and more importantly, getting lots of capital from investors to buy these loans and securitize these loans. That really allows us to kind of throw everything we've got at scaling this business and really just at the end of the day, educating. We still educate every day, but helping originators, you know, make a good living in the non-QM space. We have loan officers that the majority of their offering is non-QM, and they've kind of made a name for themselves as that, you know, self-employed expert or that investor expert or both, and that makes a big difference to a lot of people. And I think now with the rate environment and the margin compression things we've already talked about, it just feels like it's even more important in 2022.
Yeah, no, absolutely. And I think, again, from the investor perspective, you know, the idea that, you know, we're integrated and the idea that they're not, you know, 3 steps removed from the origination engine, I think is very, very critical, and has proven to be critical now, you know, having started in 2015.
Yeah, well, you know, skin in the game. That's kind of the name of the game from origination. There's no more 100% loans, and you know, it's borrowers have skin in the game. Originators obviously do. We do as the lender, and then on the securitization side, maybe even mention that. Would you kind of some of the regulations that are around non-QM securitization?
Yeah, so coming out of the GFC, the global financial crisis, and Dodd-Frank, really the regulator said, look, you've got to have skin in the game when you do a securitization. You've got to own 5% of the credit risk. So the model really sort of flipped from being an originate to distribute model where there wasn't any skin in the game to originate to retain model. And that's really where, you know, you've put up some barriers and you've put in some frictions where, you know, the credit quality really has to be very sound, given that there is skin in the game. That alongside, the other things we talk about when we educate investors on the asset class, the loan to value, the credit scores, and look, I mean, at the end of the day, they're also very aware of the housing market dynamics and the supply demand imbalance and the low inventory levels in housing, and the millennial generation, which is just coming on to being significant home buyers. So all those fundamentals are very sound, very supportive of the asset class, in addition to the things that you mentioned, which are sort of regulatory process driven, the risk retention,
Right.
and having skin in the game.
Yep. All right. Well, a couple things that I'd like to leave everybody with. I know we might have reserved an hour, but didn't want to waste anybody's time. Hopefully this was informative to kind of understand more about non-QM. Manish, thanks so much for your time. I always love getting your perspective, but want to leave with a couple of things. One is our website. Any originators out there that want to find us, go to Angel Oak MS, as in Mortgage Solutions, angeloakms.com, and there's a Find Your AE. You just click on the map and somebody will get back to you quickly. And then the second thing, I know a lot of these webinars are based around products and guidelines and what those look like, and we really haven't talked about that at all today and didn't really want this to be a product. But every month we do a product webinar, and our next one is next week on the 10th of February. It's a Thursday at 1 o'clock Eastern. So you can probably even sign up for that on our website, but be on the lookout for that. If you want to learn more about the products, go to our website. And we're just excited about what 2022 and beyond holds. Manish, always a pleasure. Thanks very much for your time. Thank you to everybody else for joining us, and have a great 2022.